You know, investing is a lot like a good cup of coffee. From a fast food joint to the corner street vendor to the boutique coffee roasters of the world, depending upon your taste, your experience, and your budget, you can eventually find the cup of joe that meets your needs. And like anything else, changes in supply and demand, markets, governmental regulations, and competition impact the availability and the price of that morning pick-me-up. Good morning and welcome to another edition of Caratel's News and Notes. Andrea D. asks about the inverse relationship between interest rates and bond prices. A great question. Let me see if I can answer Andrea's question before my morning cup is cooled. A hot cup of coffee on a brisk winter morning tends to be more valuable than that same cup that sat on my desk for the last hour or so. The coffee's the same, but the environment has changed. If, after completion of my due diligence, I purchase a bond paying a 7% coupon, I'm probably pretty happy with myself. But if, after some time passes, I want a cup of fresh hot coffee, I'm probably going to have to pay for it. My hours-old coffee, great when purchased, now really isn't worth much. I purchased a bond paying 7%, and I was happy with myself. But all else being the same, if rates have increased to 9%, my 7% bond may be worth about as much as that cold coffee. What was once of value has now decreased because of what's happened in the market. Rates went up and the value of my 7% bond went down. Conversely, if I've gotten my cup of coffee and then the coffee machine breaks, well, it may be lukewarm, but it's better than nothing. I've got my 7% bond, but if all you've got are 5% offerings, all of a sudden my cup of coffee commands a hefty premium. A really loose analogy, I know, but I hope it makes sense and I hope I've made my point. In reality, there's a bunch of math behind the calculations that go into determining how bond prices react to changes in interest rates, but those are the basics. How does the bond you own compare to what's out there in the marketplace? If yours is better because market rates went down, then you can expect a premium if you want to sell. Conversely, if rates went up, you're left with that warm cup of brown water. To sell it, you're going to have to reduce your price. Of course, no two bonds are exactly the same, and there is a lot more to bond valuation than just interest rates, but that's the gist. From the most conservative to the most aggressive, bonds, also known as fixed income investments, are an important component of any properly diversified portfolio. Future videos will begin to further introduce the concepts of portfolio diversification, asset classes, and investment strategies, so stay tuned. Until next time, thanks for watching and have a great day.